Okay. Hey guys, welcome everybody to our North Star Bat Charts channel. And guys, we have a treat today. It's been a while we haven't had a guest, and I decided to reach out to Luke Gromen, guys. Everybody from FFTT, welcome Luke to our channel. There, it's an honor to have you here. I can't wait to talk a whole bunch of stuff because we're the chart guys. But I listened to your interviews. I listened to you on the Tucker Carlson show, and like, I don't know. We can't keep up with you. Like for all the fundamental, the thesis, everything that's going in your head, it's like it's different, but I'm super curious to see how you use the charts, how you see maybe our charts, and how you're able to bridge everything together. Because sometimes we hear fundamental guys or macro guys, and we have no idea, are they using charts behind the scenes like to come up with their thesis? Like, so welcome, and I'll just let you introduce yourself, but I think a lot of people already know who you are there.
Yeah, no, I appreciate you having me on. It's great to be here. I'm a happy client of North Star Bad Charts. So I read mostly on weekends, but I love I love the charts you guys put up, especially around the macro and the capital rotation that you've been talking about. Um, and I was turned on to you guys by a friend of mine. I mean, we've followed each other on X forever, and I've always loved your charts. And so yeah, it's great. And for me, I'm not a huge short-term technical guy, but I'm a big believer. It's not that I'm not a believer, but I'm very much have a huge degree of respect for when the long-term charts are moving. And that's more how I tend to use technicals in my own, where I don't use it all the time. I kind of, I had to keep an eye on things. So you guys are allowing me to be much more systematic about it. But when you get these longer term movements in the charts that are expressing either contradicting or supporting something as I'm seeing it, it's very useful for me. I go, okay, well, I'm seeing it this way from the fundamental and how it kind of I'm my lens, and then when your lens on the longer term technicals either disagrees or agrees, it's something very powerful happening. And so I'm excited to be here and talk with you about the world.
I suppose the
Awesome.
first thing to hit on perhaps is the amazing moves made by precious metals just recently. And of course, that's got everybody talking and it's caught a lot of people's attention. And it's part of a much bigger picture process that's taking place. I think most people, whether it's analysts or technical analysts, can't fail to realize that we're moving away from an era that we have been in for quite a period of time into a very different era. And how you define that era, I suppose, depends on your perspective. Perhaps you could just explain how you're seeing things.
Sure. Yeah, so something we've been talking about for a long time has been the emergence of gold as a neutral reserve asset. And essentially started after the great financial crisis when you started seeing Russia, for example, buying gold. The Chinese started doing so. And then it really accelerated in the aftermath of 2014 after global central banks essentially stopped growing holdings of their treasury bonds. The Chinese came out at the end of 2013 and said it's no longer in our interest to grow FX reserves. We're done buying treasuries essentially. And we've done a lot of work around why all of that is, and it's really ultimately enlightened self-interest on their part, which is to say, you can't store surplus wealth in a financial instrument in FX reserves whose value has to decline against the surplus, what you're shipping in surplus. In other words, the only way the United States can make its fiscal math work after 2008 and certainly after 2014 was if the real value of long-term treasury bonds fell against oil, commodities, growth, etc. And so you started to see, starting in the BRICS, led by China and Russia, shift towards a reserve asset whose real value would either be maintained or grow in oil terms, in real terms. And so we've been talking about this shift for a while. We've been able to see central bank buying of treasuries stop and gold holdings rise. And so it's really interesting when you look at that. And then you can kind of see in the charts you guys have laid out as part of the capital rotation, the CRE capital rotation event. It's playing out in the charts over the last 2, 3, 4, 5 years in particular, and I think that makes sense fundamentally because I think in the aftermath of COVID in particular, the Powell pivot, the REAP in 2018 to 2019, the repo spike in 2019, COVID in 2020, where we had again crisis responded to by massive money printing and then since then, you've had, I think, a growing recognition amongst Western policymakers, and particularly in the U.S., that it's not in our interest. The system as it has been structured for the last 40, 50 years isn't in our interest anymore because essentially the U.S. military on the margin is made in China. We can't go to war without China's factories, and that's a significant national security threat that started to be laid bare after COVID and was made very critically apparent after 2022, which I think really is if you look at some of the charts when sort of the capital rotation event really started to accelerate when the US came out and said we're free with Europe, we're freezing Russian FX reserves. So not only we've gone from 10, 15 years ago, treasuries as a reserve asset may not be very good in real terms because we need to inflate it away to after 2022's sanctions on Russia they might not even be safe at all. We may take them if you do something we don't like. And I think that was really the moment that started, I think, kicking off this capital rotation event and further accelerated by the Trump administration winning at the end of 24 and then what they have said in 25 and year to date, which is in 26, which is basically we want to redirect capital flows. We don't want the Chinese buying the NASDAQ. We don't want them buying our technology, our companies. We want that money going somewhere else. And so you have sort of a series of actions in the last 2, 5, 10 years. Essentially, take your money somewhere else. We don't want as much of it coming to America. We don't want as much of it coming to Western financial markets. And if that's the case, with China wanting to maintain, a closed capital account, there's really only one place to take it, and that's gold. And you're seeing that, when you logically and fundamentally and the history all makes sense. So then when you start seeing it show up in the charts, it's like super powerful. It's kind of what I was alluding to before. So I think what we're seeing with gold in particular, and silver, the United States declared it a critical mineral in November, and it's been fireworks ever since. And I think part of why the U.S. did that ties into these national security imperative that we talked about before, where it's important to look at the broader message, which is dollars and bonds are less important than actual physical metals. And that's a world where you would expect to see what your charts are saying, and they're saying it.
There's one thing, Luke, there that eventually there will be a capital rotation event, but on the flip side. So as like, I don't know, I think Kevin, it's gonna be maybe 10 years. We don't know. We're gonna have to wait to see how long this ride goes on. But what's going to be like the fundamentals or the macro in words, not in charts, that once we're finished with this gold bull era and we start rotating back into stocks growth and it starts outperforming the metals once again, how is that going to play out in real life? Not in the charts, but like is China going to implode? I don't know. I'm just like how do you see that next wave on the way back?
It's a great question. In my base cases, it's just a kind of a function of price. Basically, we get back to levels um, in terms of gold's price where it starts to make sense to move back the other direction. That's probably the most optimistic view. And a fundamental chart that I've put on X a number of times, I've used for a lot of years is the gold, the price of U.S. official gold, the value of U.S. official gold at market price, right? So our 8,100 tons of gold, whatever we have, times the market price of gold, and the percentage that gold is of foreign treasury holdings. In other words, what percentage of the United States foreign debt is collateralized by our gold holdings at market value? And historically, that percentage has been anywhere long term 40 to 60%. In the dollar crisis of 1980, it was 130%. As recently as 1989, when the Berlin Wall came down and we went from a multipolar to a unipolar moment in history, it was 20%. And today, even with this massive gold rally, it's up to 13 or 14%. So we would have to rise at least another 50% just to get to the low end of that range in terms of gold prices. And that's assuming no more increase in U.S. foreign held debt ever
Right.
again, which is probably that's probably not going to happen. And more realistically, you're looking at somewhere between 3 to 5x increase to kind of get back to the long-term range, assuming there's sort of no acute dollar crisis. And so when I think about that, for me, I'm asked from time to time, hey, as I've been a very notable bear on long-term treasury bonds, long-term sovereign debt forever. I just think it has to lose on a real basis for the system not to implode. And I'm asked, what yield would you buy 10-year treasuries at? And my response is always, it's not about the yield on the 10-year that I'm interested. It's about the price of the dollar at which I'm interested again in 10-year treasuries. And that's to say, look at $20,000 gold, $30,000 gold. To me, assuming everything else, nothing else has changed massively, but just all else equal, $20,000 gold, $30,000 gold, I've now been compensated. There's for the repricing of the dollar. The dollar is now back priced relative to gold, back in line with historical norms. So at $20,000, $30,000 gold, I would be willing to take some money out and buy 10-year treasuries at 3.5%, 4%. So I think that might, sort of my base case of what ends the gold capital rotation event is just price, a snapback. We go back, a mean reversion where we're back to a price of gold relative to the liabilities of the reserve currency issuing government they've been for 80 years. And then people start feel comfortable taking on yielding liabilities, long-term liabilities of that government again. All else equal, 4% I'd rather have than no percent on gold, but I own gold because, 4% on a currency that's got to lose 8 to 10% a year. That's not a good, that's not in real terms, that's not a good deal. So that's one, from a fundamental standpoint, that's not just price driven. You would have to see, if somehow, like you said, if China collapsed and Russia collapsed and in some sort of way that it didn't blow up the system, which is hard to imagine, but let's just, because ultimately Lehman had a balance sheet, it was $800 billion. It almost took down the system. China's balance sheet is, whatever, 30 trillion. So if China blows up economically, I think gold is bid first. That could get you to your capital rotation event in a huge way quicker than 10 years. If there's a sort of idiosyncratic way where somehow the United States or somebody else is able to engineer a coup where we're able to replace sort of the entire top level of the CCP with sort of Chinese Boris Yeltsin, who proceeds to sort of sell off Chinese interests to America for pennies on the dollar, then that I think would very much be sell gold by treasuries. I think if something similar happened in Russia, same thing. But failing something idiosyncratic like that, which I think has a very low chance of happening, I look and say, okay, what about World War III? Well, I think people flood to gold more than treasuries. There's nothing more inflationary than war. And B, a quorum of the U.S. military is made in China. That is, that I don't think we could fight. I don't think we would win. It would be at best a draw, and I think a draw is at best is a good scenario for gold as well. So I don't think there's a lot that can kind of stop that. I guess the last thing would be some sort of um, productivity miracle in technology with, say, the discovery and commercialization of nuclear fusion or something, where basically you've got free energy, something that's sort of really far out there. But failing either of those two scenarios, fundamentally, I don't see a lot that changes sort of this very big move in terms of this capital rotation event at what it means for gold.
So
Goodness.
on that basis, and on the basis that historically there's a strong correlation between gold, silver, and oil, um, you've probably seen our oil charts as you remember on our website. But how do you? I'm not going to lead your answer here. I want to hear what your own thoughts are. You know what our thoughts are. So how do you see gold going through the next sorry, oil going through the next 10 years or so?
I think it's an order of operations um, that oil will eventually rise, but I think it's going to take a lot longer than people think to kind of catch up. And the reason I say that is given the debt picture of the US and of the world more broadly at the sovereign level, you can see historically over the last 5, 6 years, anytime oil has gotten much over $85 per barrel, the US Treasury market starts to break. And if the Treasury market breaks, everything's going to break, and we're going to have essentially an economic and systemic collapse. And so, my view of the the gold versus oil chart and the gold to oil ratio, my view is that gold to oil ratio is first going to go a lot higher. In other words, I think gold's going to go a lot higher. Oil is going to stay kind of range bound for the foreseeable future from the standpoint of but much below $60 per barrel, and US shale production starts to roll off, and that's not good for the global economy. Much above 85 a barrel, and the treasury market starts to collapse. That's not good for anything. And so I think that the gold to oil ratio will continue expanding for a time until it gets the price of gold gets high enough where policymakers globally can basically use their respective revaluation accounts to basically buy down debt. And then I think oil responds from that point. Once you buy down debt, now you can have oil go to 90, 100, 120, $200, whatever it goes to, without crashing the global sovereign debt markets, which is where it would go now. And I think the oil players are probably, the global oil exporters are probably willing to kind of play along with that because ultimately they want to maximize profit on oil. But above $85, if you crash the treasury market, you're actually going to crash economies and you're going to lead to lower oil demand. And that's not in anybody's interest. So for me, I think oil stays managed in the relative near term, intermediate term, in the 60 to $80 range. And the release valve continues to be this gold to oil ratio until gold is high enough that it can be revalued, debt written down, sovereign balance sheets recollateralized. And then I think when that event happens, then I think the what you guys have been highlighting in terms of oil catching up as it always has over the last 200 years or whatever it is, I think the oil catch up happens on sort of a post event in a very brief period of time, if that makes sense.
Yeah, it's because gold essentially. I remember back in the days, I did a U.S. dollar adjusted for inflation chart, and if you flip that chart, essentially it's the U.S. Purchasing consumers U.S. purchasing power. Gold front runs that 3, 6 months. So right now, while inflation might not be high, gold going up like that for me, it's telling me that it's sensing some crazy amount of destruction of purchasing power coming down the pipeline, either higher inflation or U.S. dollar going down or both. It could be US dollar losing strength and inflation because you got to remember, like, so that could put a floor under also the price of anything denominated in the US dollar if there's destruction. So that oil price, like you said, might be range bound. It might creep up a little bit because it means all those oil plays, they're all breaking out, Luke. Like I looked at Exxon, Chevron, my goodness, but they also oil plays also go up in the 80s while oil is going nowhere. These oil plays, it's like bottom left to top right from 1968 all the way to today. You own Chevron, you're doing 13% per year, like doing nothing. It's like, but so it's like people think oil plays either have to go up with oil, but even if oil goes nowhere, they could still go up though, those oil plays.
I think that's right. And that makes a lot of sense because you're going to have the return on, stable oil at a certain price is really good for these guys, right? Like for the E&P names. And so you're starting to see that break out. Something I wrestle with, and there's a very hard way. There's really no way that I'm aware of because the evidence is mostly anecdotal. But the price of gold has been capped for a long time by the expansion. Capped is too strong. The price of oil has been managed. Excuse me, the price of gold. Did I say well? The price of gold has been managed over time by the expansion of unallocated gold, credit gold, etc. And we know that that has happened. We don't know the extent to it. You know on the charts that the gold to oil ratio has been relatively stable under the petrodollar system at around, whatever, 15 to, 10 to 25, 15 to $25 or barrels per ounce, right? It's sometimes higher, sometimes lower, but it's spent most of the time in that range. Um, to me, the $64,000 question over the next 6, 12 months as we watch the price of gold is it possible that what we have watched in the expansion of the gold to oil ratio from, call it, whatever, 20 to 80 has been essentially policymakers standing aside and no longer you managing the price of gold with the intention of restructuring the system in this way, which is to say, the only thing they have left that they can do, right? They tried Doge to cut spending, it didn't work. They tried to beat up China, it didn't work. They tried to, sort of go to war on the border of Russia, it didn't work. All they have left is to devalue the debt somehow. And really, the easiest way is let gold go, revalue it, and then buy down the debt. So I think. Yeah, I think you raise a great point, which is the gold equities can do the gold or oil being in a 62 to $80 range, relatively low volatility. Those are good return on capital spots for oil E&P plays. And you're still, the decline rate on the installed shale base being what it is, right, is because those wells decline much faster. That implies a pretty healthy rate of business activity for your equipment providers and a steady rate of a steady rate of ROIC, a good ROIC for those names, and they're pretty depressed, right? They've done XOP's done, very little over the last, I'm going from memory, 3, 4, 5 years. So,
Yeah.
yeah, that makes sense to me. Like that's a world where the oil E&P names can be fine. Oil doesn't have to go too far because it can't, because it'll break the treasury market over 85. And, then you have a release valve where gold to oil ratio keeps rising for a time and the E&P names do pretty well.
Of course, that's potentially very good news for mining companies as well. If the price of gold is going up, obviously a big input cost for the mining companies is energy and oil. So the longer they can stay within that range that you're talking about, the longer they have the opportunity to benefit from that. Um,
Yeah,
I
I
would
think
still
that's
move
right. And I
on.
think there's a
Yeah,
lot of people that the miners, they still don't, I think the miners have only just started repricing the possibility that 80 plus is a new normal for the foreseeable future. I think those shares would be way. If you came to me and said, Luke, if where would GDX be if the world knew for certain that the new normal is a gold to oil ratio of
Mm.
100 to 200 barrels per ounce? And
Mm.
I think GDX wouldn't be 100. I think GDX would probably be 300 or
yeah.
200. And that's one of these sort of big $64,000 questions. I think the new normal for gold to oil ratio probably is over the next couple of years 100 to 200 barrels an ounce, maybe more, until again we can get gold to a level that sets up the revaluation, the buy down of debt, the restructuring of the system, and then go. And that's, I think, the inflation that you talked about, Patrick, of that's when I think sort of the Main Street inflate. Because what you're really talking about is creating money, creating new money with no new debt offset through gold to buy down debt that is very, very inflationary.
Yeah, it's we saw in the 70s there. Kevin had a few charts there. The debt to GDP actually went down in the 70s because of all that inflation. I think it must raise the GDP, right? Because the cost of everything that's in there. And then after that, that was a way to bring it down. So it's like inflate or die, right? It's like unless they do something like the late 1800s, where I don't know what the hell they were doing back then, but the purchasing power actually increased. Silver price was going down, oil price was going back down in the late 1800s, all the way maybe to 1910, 13. Where the Fed started. I don't know. It's funny. But then after that, it's like they have to destroy the purchasing power for the system to keep, you know.
And of course, GDP is, as we've said before, money supply multiplied by money velocity. They are the identical chart. So if you want to increase GDP, then simply increasing money supply sends GDP up. So, to my mind, if you're wanting to increase GDP, then that's the simplest way of doing it. As Pat said, the debt to GDP decreased from 130%, I think it was, down to about 70% through the 1950s, 60s, and 70s. So the burden as rates were rising, interest rates, inflation, bond yields, the burden was becoming lighter, the GDP, debt to GDP burden. Now, fast forward to today, I think debt to GDP did actually reach about 129% at one point, and it's sort of eased off a little bit from that. But it's going to be fascinating on that chart to see how debt to GDP um, sort of reacts going forwards, because that can potentially fall if we get a huge amount of money creation. But I don't know. It starts getting into some murky waters there for me, because then you start creating a whole load of unintended consequences, probably.
No, that's right. You can see, in World War II, we ended, I think, at 110% debt to GDP, and they got it down to 55% within 5 years. And U.S. real rates bottomed at negative 13%. And the Fed was capping yields at, front end at 3/8%, 10-year at 2.5%. You had capital controls in place, et cetera. But you were down to 55% by 1951, and then you could do the Fed Treasury Accord, which reseparated the Fed and Treasury, and yet you still kind of continue that same playbook. So by late 60s, early 70s, you were down to 25, 30% of debt to GDP. And so at that point, when inflation picks up, you can really let bond yields go wherever you need them to go, because there's no threat of rendering insolvent the federal government. They could pay whatever interest they needed to pay. And oh, by the way, the entitlements were basically nothing still at that point because of demographics, what have you. And like you said, fast forward to today, we're at 120%. It's down from 130% at the peak. To get it from 130% to 120% took the US running, call it 15% nominal GDP growth with 8 to 10% CPI, and the Fed buying bonds at essentially zero. And when you look at it that way, it just gives you a brief glimpse. If that's what it took for us going from 130 to 120, what would it take? It would take another 5, 6 years of those types of numbers to get it probably from 120 down to something more sustainable, 70, 80%. Um, and like you said, that would create a whole bunch of second derivative problems, obviously political stability problems, which we already have in probably greater amount than we've had in at least 60 years and maybe 100 years. And the other issue that is generally left off by lots of people to talk about it is the entitlements are dollar denominated obligations only in sort of the strict sense. What they're really, particularly Medicare, Medicaid, they don't owe dollars. They owe hips, knees, pharmaceuticals, doctor's time, inflation. It's essentially a hard currency. The entitlement portion of the U.S. Off balance sheet liabilities coming on balance sheet are very similar to Weimar Germany when they owed the money in gold Reichsmarks. So the more they printed, the more the obligation went up. And the more they print in the US, the more the cost of healthcare goes up, the more the cost of, and so, I think there's some things they're doing around fraud that they're trying to reduce that before they sort of print, which is, I think, smart. I think that's probably has something to do with some of why they've been trying to crack down on some of the fraudulent related activity that you're seeing in Medicare, Medicaid. It's pretty widespread from what I hear. But at the end of the day, the more you print, the more the cost of healthcare is going to go up, which means the more you need to print. It's a very precarious scenario that is very different than where we were in the 70s. And to me, ultimately, when you boil it all down, it goes back to, like you said, Patrick, you're basically in a print or die scenario where to maintain the nominal solvency of the system, you're going to have to inflate. And I think, that all ties back to that capital rotation event, which is, you know, everybody knows that everybody knows, right? Once you hit a common knowledge point, it is starting to become obvious that I think to everybody in markets, the market is telling us with the capital rotation event that this is the only way out, and therefore I need to own some gold, I need to own some silver, and and in particular gold, with all those different that great chart you guys have of the 12 different sectors and factors all entering bear markets
Mhm.
like 1930, 1972, 2002. Like they're like buy gold, go to the beach, come back in 10 years and figure out what you want to do.
It's quite curious at the moment because Pat and I have been sort of brainstorming this, and the capital rotation process is pretty well advanced now with gold having broken out versus all of those instruments, and particularly the stock markets, which is the largest sort of factor of a capital rotation process. But the event, as we define the event, the part of it that makes it blatantly clear to everybody that this is something that is massively important is when the stock market begins to suffer a significant decline, but not just on its own chart versus US dollars, but also versus other assets. And so watching the stock market decline versus, for example, PPI and CPI and M2 money supply and all that kind of stuff is the other part of the equation. And that hasn't happened yet. The stock market hasn't crumbled. It has actually broken out above a technical resistance line, but since it did that, it hasn't really moved anywhere quickly. So my question to you is, and also bearing in mind the Bitcoin is plummeting as we speak. It's fallen from 126 down to wherever we are now, approaching $70,000, I think. So a bit of a long-winded question, but how do you see Bitcoin going forwards, given that it has never had to encounter a capital rotation event and it's never existed in a pro-gold environment? And how long do you think the stock markets can continue to hold up?
Yeah, I think Bitcoin is going quite a bit lower, unfortunately. I'm someone who loves Bitcoin as an asset, but there's a time and place for everything. I'm on record infamously for selling most of my Bitcoin around 95, 96,000, around 23, 24 ounces of gold. And I think, and that was one of those times where, you can kind of see it as a fundamental guy. It's like, it's not acting right. It's not acting right. It's not. And then you see that breakdown of like on a monthly chart against true strength, moving average conversion, whatever sort of technical momentum you want. And I wrote to my clients that this has to be respected. A break, I'm not a big technical guy. I know like you guys have forgotten more in 10 minutes than I'll ever know, but I know just enough having been in this business for 30 years. Like when you see a long-term momentum
Yeah.
break down at nearly a vertical, on the momentum indicator, like that has to be respected. And I literally wrote those words, like that has to be respected. I'm out. And so, um, I think unfortunately it has a lot further to go because these cycles with Bitcoin have tended to be they tend to only bottom when the levered players are getting forced liquidated, right? So to me, I see the growth in treasury companies and obviously strategy, with Michael Saylor is the biggest example, but there's a whole bunch of these that have popped up in the last 18 to 24 months, and they're levered long. And a lot of them are at cost bases higher than Michael Saylor by de facto because they came later. Um, and so at some point, I think that's to me my working hypothesis, and my working hypotheses tend to be, firmly arrived at but loosely held. Is that essentially the treasury companies are going to be the FTX of this cycle.
Mm.
I think Bitcoin will go lower than people think, and then you'll get forced selling. And I think I want to be, once I start seeing headlines of enough treasury companies being forced to sell Bitcoin for dollars to service debt, that to me is where I think A, I want to be buying it, and B, and my guess is you'll start seeing those technical indicators, while they won't cross back up on the upside on the long term because it's just a lag, I think you'll see them start to narrow and bottom when that starts to happen. Again, that's my fundamental working
So
excess.
I want to ask you a question, and until now I've sort of barely dared to ask it really, and because people think you're crazy. But given that Bitcoin, okay, I'll start this question a different way. Given that the crypto total market cap completely failed to make a new high versus gold in this recent bull market, and given that Bitcoin itself barely made a new high versus gold in this bull market, and given that gold is expected to be in a bull era for a number of years, and we've spoken about the targets, um, how do you how do you feel about the idea that Bitcoin going forwards makes a series of lower highs and lower lows in the next couple of cycles? So if we go with a 4 year cycle theory, which every 4 years, I mean, so far, even given the latest bear market, the 4 year cycle theory is still holding true. It topped when it was meant to in terms of time. And if it falls 77% like it did last time, it'll bottom out below $30,000. So, but I've heard some commentators saying, oh, well, we didn't go as high in this bull market, so therefore we might not go as low in percentage terms. But the way I'm looking at the chart, um, I don't quite see it that way. I'm seeing a lot of underlying weakness and a lot of red flags and worrying signs. So I'm just wondering if it's possible that, let's say, over the next 5 to 10 years, Bitcoin in that 5 to 10 year period makes no further highs against gold, and even when it moves into its next bull market, doesn't get as high as 126,000 before rolling over into its next bear market. What do you think about that scenario?
I think it's possible. I think it's very possible. To me, one of the reasons fundamentally I was getting nervous before I saw that technical breakdown was exactly that. The fact that every other cycle, it wasn't even close. Bitcoin massively outperformed gold, right? You would and the rate of change, right? It was whatever, the rate of change of peak of how many ounces of gold, right? So whatever, it went from zero point 0.1 ounce to 11 ounces to or to zero point 0.1 ounce to 1 ounce to 10 ounces to 30 ounce, whatever it was, right? And then 30 ounces or 35 ounces to 36 ounces. And you'd never gone that span of time where you hadn't completely destroyed gold, right? Like if the narrative, if the mainstream narrative was holding, you wouldn't have seen it fighting, Bitcoin fighting at 35, 36, 34 ounces of gold. You'd have seen it blow through there like a hot knife through butter and be at 55 or 60 ounces of, maybe even, 45, 50, 60 ounces of gold, but it hadn't done that. And so that to me was just, it was a splinter in my brain, right? When you see these things that go,
Mm.
I know the narrative, I know what's happening. They're not mixing. You've been around markets enough, both of you. Those are the kind of things where you just go, okay. You make a mental note, you wait to see for resolution. The resolution was it broke on the downside, of course, on the technicals. I'm out. So when I look at, I think you guys have a great chart that shows the rounding top, right, of Bitcoin. I think you're kind of referring to that of the Bitcoin priced in gold, and that chart is rounding.
The Doom
And
Dome.
yes, the
The
dome.
Doom
And
Dome.
I'm partial to that dome. When I look at that, I could see that happening. I'm also like I could also see it not happening. I don't, I think it's entirely possible. I don't have a strong view on that. I'm open to sort of both being the case. Some of that I think depends on events and what have you, but I could absolutely see that playing out. Yeah, I'd answer your question too, I guess, before on the equity side. Going back,
Yes.
I never answered that, Kevin, of with equities not, having not breaking down as much against sort of PPI, et cetera. Equities in the U.S., U.S. is whatever 65% of global equity market cap. So, and in the U.S. equity, it's a matter of national security for stocks to go up. Um, because they're the key marginal driver to tax receipts, to consumer spending. Um, the number we came out, we looked at the IRS data back in 2014, and we keep track of it. And if you look, so U.S. consumer spending is, call it, two-thirds of GDP. Um, and that's personal consumption expenditures, or PCE. The net capital gains plus taxable IRA distributions alone are about 200% of the annual growth in PCE. In other words, if stocks don't rise, consumer spending mathematically cannot grow in the United States, which means GDP likely cannot grow. And so there is a dynamic, a political dynamic within the technicals that you're discussing that may be manifesting in terms of the reticence or the stubbornness of stocks not to fall as you might otherwise expect in this capital rotation event. And my view, based on the fundamentals, is I would be open as a technician to that not happening this time as much as you might think, and that instead the release valve might be gold going, equities falling more in gold or gold going up more in equities, simply because policy of the last 20 years has allowed equities to become the key marginal driver. The U.S. government, the Treasury, by virtue of this, equities back the Treasury market. So they can't let equities go down a ton and stay down for very long before it's going to blow up the Treasury market because they simply won't have the tax receipts to pay the interest and the entitlements. And so I think it's a really important point to raise in light of that second part of your prior question, Kevin, because I think I'm very open to that being the case based on the fundamentals that it wouldn't invalidate the capital rotation event. It just might be an idiosyncratic feature because equity market cap in the US is so big and it's so important to preventing the collapse of the treasury market and the system more broadly.
It's
And
like
that's where technical charts come in, because until the support line breaks, then from a technical chartist point of view, there's no need for us to worry about anything bad happening with the stock market. So all we do is we just monitor that support line. Sorry, Pat, you're going to say something.
Yeah, well, it's just like sometimes, people, they think a dot-com bubble, 80% drop, whatever, 70 GFC. But I think if we're more likely the market is going to go down, it's probably going to be 30%, then a recovery rally, then maybe drop of 40%, then a recovery rally, and just kind of go sideways a little bit like it did in the late 60s to like almost to 1980 there, but nothing too violent, right? That the yields going up, destruction of purchasing power is going to put a floor under crazy drops like we had in the GFC era or the dot-com bubble. I don't think like at the beginning, maybe it's a scenario. We'll see with the charts, but I'm more angled that this destruction of purchasing power is going to put a floor on everything, but it's going to fuel more gold commodities and and those guys and price and inflation. The stock market might lose 80% of its value, but nominally it might not go that deep. It might, like you said, it might be a succession of smallish corrections, small bear markets, nothing much happening, but yeah, adjusted
Yeah,
for
that's kind of my
inflation.
base case. Yeah, that's kind of my base case. And I
Yeah,
think you could also get like a vicious sector rotation within that. Like you kind of had
yeah,
02, 03 through 08, right? Where NASDAQ was still just sort of doing nothing. And actually even earlier, right? Because everything kind of bottomed 02. But you go back to like 01, 01 to like 07, NASDAQ still was falling for kind of the first year and a half, 2 years of that period nominally. But you were having this powerful bull market emerge in industrials and commodities that kind of continued. And so on the surface of the market, it was like nothing much happening. But underneath the surface, you had a vicious bull market or a strong bull market in commodities, industrials after like a 7 year bear market, and vice versa for tech, where you were still sort of working off the excesses, and then finally it started getting dragged along too. I could absolutely see something like that happening as well within
Well, of
that.
course, I mean, the sectors in the S&P include things like basic
yeah,
materials and
energy.
energy and that kind of thing. So, it's very easy to imagine that scenario, isn't it?
It's
Yeah.
it the SPX is super powerful. Like it has those 11 sectors. It rebalances. If energy is at 1 or 2, 3%, then it has room to inflate. And then it's like we could just everybody retire us, and people like you said they could just buy the SPX or they have a long-term vision, buy it like and reinvest the dividends and sleep well at night. Because like you said, the whole system is based on that. If it implodes, it's like it's over for everybody anyways. So it's like it's kind of, but us, we like the timing. If we're going to go in a 10-year of outperformance for another asset class, it'd be stupid not to look at it. It's just like why, like, if we're outperforming gold and silver's outperforming gold, like might as well go in those assets because time is money, right? Can't,
Well, that's it. So, I mean, spotting those rotations is important because I think over the sort of 12-month period last year. I think the S&P went up something like, I don't know, 15%. It was that kind of ballpark where, we saw gold going up 65, 70% and silver, whatever it was, 200 and something percent. And that was quite easy to it's quite easy to spot that because of the ratio charts. You can spot that rotation. So to us,
Uh,
it doesn't really matter if the S&P isn't plunging. It's more important that we're outperforming inflation and outperforming the stock market, or outperforming, just positioning in whatever happens to be the stronger performer at the time. Because as an investor, you want to be increasing your purchasing power. That's what it's about at the end of the day. Increase your purchasing power and put your hard-earned money to good work.
Luke, I don't know. I don't want to take too much of your time, but I don't know if you have some closing words to wrap it up there, so our viewers, where could they find your stuff and anything insightful that might be of value.
Oh, thank you. Yeah, if people are interested in learning more about our work, it's fftt-llc.com for more information about our institutional and mass market products. And they can find me, as you guys mentioned, on X at Luke Gromen, LUKEGROMEN.
Brilliant. And
And
we're
they
going
can
to
probably
share
talk to you in
this.
the comments on our website as well, Luke.
Oh,
That's right.
thank you.
Yeah. Like we have a famous member in our website. It's like some who knows is it in the crowd. It's funny sometimes we think it's all just retail, but sometimes you have fund managers, you have a whole bunch of people who want data, right? And some of our members might sign up to your stuff because they want data from that speaks to them. So that's important for everybody there to get all this content to help make better decisions.
Yeah.
All right, guys, that was fun. Thank you, Luke. It was an
All
honor
right.
to have you on the
Thanks for having
show.
me on. Thanks. I really enjoyed our conversation. So look forward to chatting with you soon.
All right, awesome.
All right. Take
Thanks.
care,
Bye,
guys.
guys.
Bye-bye.